It begins with a headline that shakes the world. Intel, a titan of the semiconductor industry, has declared bankruptcy. The announcement reverberates across Wall Street, technology corridors, and governments worldwide. Analysts scramble to assess the fallout, investors react with panic, and technology companies confront an unprecedented crisis in supply chain stability. The implications are immediate, multifaceted, and global. Intel's stock collapses almost instantly. Shareholders, institutional and retail alike, rush to sell, triggering cascading declines across the Nasdaq and tech-heavy indices. Pension funds, 401k accounts, and mutual funds heavily invested in Intel face massive losses. Trillions of dollars in market capitalization vanish in days, shaking confidence not only in the company but across the semiconductor sector and broader stock market. Investors begin to question the stability of other chip makers, amplifying volatility. The U.S. technology industry feels the immediate impact. Intel supplies microprocessors, chipsets, and critical components to companies ranging from PC manufacturers to cloud computing giants. Hardware companies reliant on Intel chips face sudden shortages, production delays, and cost increases. The ripple spreads to software companies, data centers, and enterprise solutions providers who depend on Intel's technology for performance and reliability. Product launches are delayed, contracts renegotiated, and R&D pipelines disrupted. Global semiconductor supply chains react with alarm. Intel's suppliers, subcontractors, and partners experience order cancellations and payment delays. Foundries, packaging plants, and materials suppliers face operational uncertainty. Competitors like AMD, NVIDIA, and TSMC see both opportunities and pressure as clients scramble to secure alternative chip supplies. The sudden void left by Intel destabilizes an industry that is already tightly interconnected and highly sensitive to disruptions. Consumer electronics markets experience immediate effects. PCs, laptops, servers, and data storage devices face production bottlenecks. Manufacturers may increase prices due to scarcity of components, passing costs on to consumers. Electronics retailers adjust inventory and marketing strategies, anticipating slower product rollout and reduced consumer demand. The loss of Intel as a reliable supplier reshapes pricing, availability, and competitiveness across the global tech market. The broader U.S. economy feels measurable consequences. The semiconductor industry is integral to U.S. GDP, employment, and innovation. Intel employs tens of thousands directly and supports hundreds of thousands indirectly through suppliers and partners. The bankruptcy threatens jobs, regional economic stability, and corporate investment plans. States hosting Intel facilities, research labs, and supply chain partners experience localized economic stress. Unemployment risk rises as production halts and support services contract. The federal government and regulators respond rapidly. Lawmakers, aware of Intel's strategic importance, consider emergency measures to stabilize the semiconductor sector. Agencies like the Department of Commerce, Federal Reserve, and Securities and Exchange Commission coordinate to monitor market stability, assess systemic risks, and explore intervention options. Proposals include emergency funding for chip manufacturing, incentives for alternative suppliers, and temporary regulatory relief to facilitate continuity of supply. Investor confidence in the broader technology sector is shaken. Companies heavily reliant on Intel, from cloud computing firms to PC manufacturers, see stock price declines. ETFs and mutual funds focused on technology experience volatility as analysts reevaluate risk exposure. Wall Street's perception of sector stability shifts, leading to cautious trading, reduced capital inflows, and heightened market anxiety. The psychological impact of Intel's collapse spreads across corporate and consumer behavior. Corporate America confronts operational and strategic challenges. Tech firms dependent on Intel for mission-critical infrastructure must diversify suppliers, redesign hardware, and adjust production timelines. Startups reliant on Intel's chips for prototypes and products may face existential threats. The disruption slows innovation, delays launches, and forces companies to reassess long-term growth strategies. Investment in R&D may be deferred as firms allocate resources to crisis management. The global semiconductor industry experiences cascading effects. Competitors and alternative suppliers must scale rapidly to fill Intel's vacuum. Supply bottlenecks, increased demand, and manufacturing constraints create price volatility. International governments monitor the situation closely as semiconductor stability is essential for defense, communication, and industrial technology. Trade relationships and national security considerations intertwine as the U.S. and allies face potential vulnerabilities in critical technology sectors. Consumer confidence is affected. News of Intel's bankruptcy triggers fear over the reliability of technology products, future costs, and availability. Households delay purchases of PCs, laptops, and electronic devices. Businesses defer investments in IT infrastructure, cloud adoption, and enterprise computing. The contraction in technology consumption ripples through retail, logistics, and manufacturing, creating secondary economic effects beyond the semiconductor sector. The bond and credit markets adjust. Companies seeking financing for alternative chip supplies, R&D continuity, or production scale-up experience higher borrowing costs. Investors demand risk premiums to compensate for uncertainty in a disrupted technology ecosystem. Lenders reassess exposure to firms heavily dependent on Intel, influencing capital allocation, interest rates, and market liquidity. The financial consequences extend beyond direct equity losses. Legal and regulatory ramifications emerge. Intel's bankruptcy triggers lawsuits from shareholders, partners, and clients. Contractual obligations for supply agreements, licensing, and R&D partnerships come under scrutiny. Courts and regulators work to mediate disputes, enforce obligations, and provide clarity to affected parties. The legal process prolongs uncertainty, maintaining downward pressure on investor sentiment and corporate confidence. International markets reflect concern. Global technology companies with dependencies on Intel's components experience stock declines. Semiconductor export flows, import reliance, and supply chain logistics are reevaluated. Countries with large-scale tech manufacturing, including China, South Korea, Taiwan, and European hubs, adjust strategies to capture market opportunities or manage exposure. Currency fluctuations, trade negotiations, and investment realignment occur as international stakeholders respond to systemic disruption in a major U.S. technology firm. The stock market experiences sustained volatility. NASDAQ and tech-heavy indices drop significantly, driven by uncertainty over revenue, supply chain continuity, and consumer demand. Market analysts downgrade forecasts for technology firms, with ripple effects into industrial, consumer, and financial sectors. Hedge funds and institutional investors reevaluate positions, reallocating assets to safe haven securities like U.S. Treasuries, gold, and diversified ETFs. Retail investors experience psychological stress as portfolio valuations plummet, amplifying selling pressure. Corporate strategy across sectors adapts. Companies accelerate diversification of suppliers, consider alternative hardware architectures, and invest in R&D to reduce dependency on any single semiconductor manufacturer. Collaboration with competitors, government agencies, and research institutions intensifies to stabilize supply and foster innovation. Strategic planning increasingly emphasizes risk mitigation, supply chain redundancy, and contingency preparedness in response to Intel's collapse. Employment impacts are significant. Intel directly employs tens of thousands, while its bankruptcy affects hundreds of thousands, indirectly through suppliers, partners, and ancillary services. Job losses span engineering, manufacturing, logistics, administration, and research. Regional economies with high Intel concentration experience spikes in unemployment, reduced local spending, and decreased tax revenue. Workforce retraining and government assistance programs become essential to mitigate societal disruption. Innovation ecosystems are disrupted. Intel's research labs, innovation centers, and joint ventures contribute to technological breakthroughs in microprocessors, AI, autonomous systems, and quantum computing. Bankruptcy halts ongoing projects, delays new initiatives, and forces intellectual talent to migrate to other companies or industries. Global leadership in critical technologies faces temporary erosion as research continuity is interrupted. Consumer electronics pricing is affected. Scarcity of Intel chips leads to higher costs for computers, laptops, servers, and gaming devices. Electronics manufacturers adjust pricing strategies to reflect component shortages, logistics challenges, and risk premiums. Retail markets experience inventory bottlenecks, slower product cycles, and consumer frustration. Secondary industries, including software development, peripheral devices, and cloud services, are indirectly impacted. Government intervention becomes likely. Policies to stabilize the semiconductor sector may include financial support, tax incentives, and infrastructure investment. Emergency measures are considered to prevent systemic risk in defense, communication, and industrial technology sectors. Coordination between federal agencies, industry associations, and global partners aims to mitigate disruption and restore supply chain stability. Investor sentiment slowly adjusts. While immediate panic subsides, long-term confidence recovery requires demonstrable progress in restructuring, supply chain continuity, and market stabilization. Equity valuations reflect risk-adjusted forecasts, incorporating potential competition, technological innovation gaps, and strategic realignment. Financial markets remain sensitive to Intel-related news, highlighting the interconnectivity between corporate performance and broader economic stability. Startups and small technology firms face unique challenges. Many rely on Intel chips for prototyping, production, and R&D. Delays or cost increases threaten viability, forcing innovation timelines to extend or pivot strategies entirely. Venture capital investment becomes more selective, emphasizing firms with diversified supply chains or alternative chip technologies. The broader entrepreneurial ecosystem experiences slower growth, reduced risk-taking, and heightened operational caution. Global trade and logistics are impacted. Semiconductor shipments, supply chain contracts, and cross-border technology flows are disrupted. Transportation networks, customs processing, and freight planning require adjustments to accommodate shifts in demand and alternative sourcing. The interdependence of technology markets ensures that Intel's collapse reverberates across continents, influencing economic activity far beyond the US. Corporate mergers and acquisitions are reevaluated. Companies consider strategic acquisitions to compensate for Intel's market exit or to secure alternative supply chains. Deal valuations adjust to reflect new risk dynamics, and investor expectations influence negotiation strategies. The pace of corporate consolidation in the semiconductor and technology sectors may accelerate as market gaps emerge, reshaping competitive dynamics. The global economic ripple continues. Countries reliant on U.S. technology exports face slower adoption of computing infrastructure, delayed industrial automation, and constrained innovation pipelines. International investors reassess exposure to U.S. equities, influencing capital flows, interest rates, and currency markets. Economic planners adjust forecasts to account for reduced technological output and altered trade patterns. Consumer confidence in technology brands is affected. Companies previously relying on Intel components must reassure customers regarding product reliability, availability, and performance. Marketing campaigns, warranties, and service guarantees are adjusted to maintain brand trust. Delays in product launches influence consumer spending patterns, further contributing to economic contraction. The semiconductor ecosystem adapts. Competitors like AMD, NVIDIA, and global foundries scale production, diversify offerings, and invest in R&D to capture market share. Supply chain redundancies, alternative architectures, and strategic partnerships proliferate. Market dynamics shift, with winners gaining competitive advantage and late adopters scrambling to adjust. The industry enters a period of rapid transformation, innovation, and strategic recalibration. Employment, innovation, and financial stability gradually recover as alternative suppliers scale production and technology companies adapt. Government incentives, industry collaboration, and market adjustments contribute to systemic stabilization. However, the memory of Intel's bankruptcy endures as a cautionary tale of systemic risk, corporate dependence, and the fragility of interconnected technology ecosystems. Ultimately, the bankruptcy of Intel illustrates how the collapse of a single corporate giant can ripple across every layer of the US economy, the stock market, and global technological infrastructure. It demonstrates the fragility of interdependent industries, the psychological impact of financial shock, and the critical importance of strategic planning, diversification, and innovation resilience. The story of Intel's hypothetical collapse is not merely a tale of finance or corporate failure. It is a narrative of innovation, risk, and the intricate web that connects markets, technology, and society. The consequences are far-reaching, systemic, and enduring, reshaping the landscape of U.S. technology, global trade, and economic stability for years to come.